So what's the biggest tax bill that you've seen, just because someone maybe didn't know any better or they didn't file out the paperwork correctly?
Yeah, it's hard to think of off the top of my head, but for example, if someone was purchasing an aircraft, let's just use a $10 million purchase price, for example, and let's say they're based in California and they closed in Montana. So they think they are good to go. They close somewhere with no sales tax, but they fly the plane home to California, base and hangar the plane in California. That could be a $1 million use tax liability before interest and penalty. So could end up having a surprise bill well in excess of $1 million.
Hello and welcome to the Jet Life Podcast. My name is Tom Lelio. I'm your ultimate jet guide. Today we're pulling back the curtain on private aviation to talk about taxes, saving you guys some money. And we're here with KJ McCarty with Aviation Tax Consultants. KJ, thank you so much for being here today.
Yeah, thank you for having me.
So let's get right into it. What's the deal with taxes in aviation? Like, it feels like if you can afford a jet, I mean, you should be able to afford, paying your taxes or whatever. But I guess the first question I have is, who pays taxes when it comes to an aviation transaction? What's the deal with taxes when it comes to private jets?
Yeah, generally, as far as the sales and use tax and personal property tax liabilities go, those are in the buyer's court. There can be some obligation for the seller to have to collect sales tax from the buyer, depending on the facts, but generally those liabilities really rest with the buyer. So sales tax, which is what can be incurred at the closing location, that's buyer's liability. Seller may have to ask about collecting it or may have to be shown proof of exemption from the buyer. And then when the buyer returns home to wherever they're going to base, hangar, and utilize the plane, that use tax liability is their responsibility as well.
Gotcha. Is there ever a time when it's the responsibility of the seller to pay any taxes, or an expectation or responsibility to inform?
Generally not, as far as these sales and use tax and personal property tax liabilities go, except for that potential obligation to collect the tax from the buyer and then send it into the state. So it's still the buyer paying. Seller's just kind of on the hook from the state to ask about the tax and maybe have to collect it. But generally speaking, if closing occurs somewhere neutral, then it's really all on buyer for the most part.
Gotcha. Okay, great. So taxes are the buyer's responsibility. Let's talk a little about Aviation Tax Consultants. Let's talk about your company. So tell us a little bit about yourselves, what you guys do, and what your expertise is in.
Yeah. So our firm is Aviation Tax Consultants. We've been in this space for a little over 20 years now. Actually just celebrated our 20th anniversary in November of last year. And aircraft tax planning is literally all that we do. All of our clients own aircraft. We don't do any other type of tax planning. We don't do boats. We don't file any income tax returns. So we're not your typical CPA firm. We just act as advisors and consultants on aviation specific tax matters for our clients and their CPAs. So all of our clients have their own CPAs as well. We're designed to work with those CPAs on these matters. And our client CPAs generally love us because we come in, we have all the answers to these somewhat confusing tax questions related to aircraft. We've done this thousands of times, and we can ensure all goes smoothly. And many of our client CPAs haven't dealt with very many planes at all, so they're a little bit uncomfortable. We can come in and help ease their concerns because we've done this so many times.
No, I love that, and I appreciate that you work with you work with the team that's already there. So many times people think about it and they're like, oh no, I need to get an aviation account, and that needs to be a whole separate thing. You guys work hand in glove with the team that's already present. It looks like, just by looking at the website, it looks like it's kind of like a family operation. And so I guess my question is, did you come into this industry through family, or how did you get involved personally when it comes to aviation?
Yeah, so Daniel Chung and my dad, Fred McCarter, founded the company a little over 20 years ago. So that's how I got involved. I grew up around it. My dad was a private pilot. We flew around in an SR-22 actually for a few years. So grew up in the space and then ended up becoming a CPA. So that's how I got involved.
Cool.
And Daniel's been in this space for even a bit longer, maybe 25-ish years now. And Daniel's son, Cody Chung, actually works with us as well. So it's kind of a family business on both sides.
I love that. That's very cool. So let me ask you this: or when should people start talking with a aviation tax consultant? Should it be when they're starting to buy a jet? Should it be when they want to sell their jet? Should it be the day before closing? You advise people to get in touch with you.
That is an excellent question. And the answer is absolutely before closing occurs, and hopefully about a month or so prior to closing is kind of that sweet spot. We get a lot of calls that are the day before closing and some that are even a couple days after closing, or maybe a plane's been owned for a year now. But our planning is most effective when it's being performed about a month or so prior to closing. And why that matters is how the plane is titled is absolutely critical to the income tax planning that we do and how the plane's reported for IRS purposes. So we want to have some say and collaborate with our clients and their CPAs on how the plane's going to be titled. And then we also want to talk about where we're going to close. That's really important, and how we're going to prepare for the potential use tax liability that buyer will have in the state where they'll base the plane.
Gotcha. So how the plane is titled is going to be critical. Can you just because it's like kind of like titled is kind of I don't know how to explain it, but like maybe like a industry term. What does that mean? How the plane is titled? Does that mean on the FAA registration? Does that mean on the bill of sale? Does that mean on the aircraft purchase agreement? Does that mean on all the documents? What are we looking like? What are we looking for when you say that how the airplane is titled is critical?
Yeah, really what I'm referring to there is how is the plane ultimately owned? Almost everyone buying a private jet, for example, is going to own the plane in a special purpose entity. So it'll be some LLC that just holds title to the plane, probably not their operating company directly. So the FAA registration will show this LLC that's, for example, maybe it's just the tail number of the plane, LLC. It doesn't really do anything besides hold title to the plane. What we care about a lot from a tax planning perspective is what entity then owns that LLC. Where are the deductions from the plane going to flow and be reported for income tax reporting purposes? Because if it's done improperly, one, it can make the deductibility of the plane much more difficult to support. And two, it can also draw a lot of attention to the aircraft from an income tax reporting perspective, because the plane's kind of sticking out like a sore thumb, if you will. We like to have the opportunity, like I said, maybe a month or so prior to closing, to chat with the buyer and their CPA about which entity should own that aircraft special purpose entity, so we can get a plan in place.
Gotcha. Okay, so I'm going to pull up my screen here, and if you can just kind of walk me through, because I'm not an aviation tax person, and so I want to walk through what does it look like. So let's see. Okay, so here's the November. Let's see. Let's do it like this. Whoops. I'm going to show you the entity, or this is November 1, 2, 3, Tango Lima. Okay, so this is the entity that owns the plane, right? So here's the plane, like my little jet. Okay. So that entity owns the plane. So this entity is going to be charged with taxes, correct? And that's where we get into sales and use tax, right?
Right. That entity, the purchasing entity, would be responsible for the sales and use tax on the plane.
Okay. Gotcha. Okay. So this is the purchasing entity. Now that we're dealing with, okay, so purchasing entity is responsible for taxes. So now that we have the purchasing, now that we're dealing with a private jet here, most people will have this company just by itself and pay taxes, or you're saying it's usually under another company that's also going to be responsible. Like, how does this work? I guess my question.
Yeah. So if the buyer is working with an aviation tax professional like our firm or a firm similar to ours, typically that LLC will be owned by an operating company of some sort. Generally
Okay.
speaking, sometimes there's reasons why that may or may not be possible.
Sure.
But most frequently, that would be owned by an operating company for a variety of reasons. But
So if I'm buying my first jet, number one, I want to set up an LLC to own the jet. I don't want to own the jet as Tom. I want an LLC to like you said, a special purpose entity to own the jet. So let's call this, like you said, November 1, 2, 3 Tango Lima LLC. Okay, so they own the jet, and now there's an operating company, which might be like my tech company that I own.
sure, yeah, any
Okay.
sort of operating company, especially one that is going to have business use for the plane, could be the
Oh,
owner of
okay.
that LLC.
I'm sorry. It could be what?
An operating company that would have business use for the plane and lots of incomes and activities potentially would be a candidate to own that special purpose entity.
Okay, and then do we have to go even further back, or now this is the operating company? Like when the government sends a tax bill, are they sending it to the purchasing entity, or are they sending it to the operating company, or does it go to the purchase entity and then the operating company pays it? Like this is kind of where I start to get cross-eyed.
Sure. If it's a sales and use tax liability, that would be coming from the state. So let's use Florida as an example. If
Okay.
Florida reaches out about sales or use tax on this plane, they would be sending that to the purchasing entity, and that's who would be on the hook for that. Now, purchasing entity is owned by operating company, so it's kind of one and the same for the most part.
Gotcha.
It's really Tom's pocket that's going to be paying.
Right.
If we're talking about an IRS matter, if purchasing entity is wholly owned by operating company, the two will be reported together on the same tax return. And we like that. That's a reason why we set it up this way. So if the IRS reaches out and it has questions about the plane and is, for example, going to conduct an audit, it would really be auditing the tax return of operating company, and purchasing entity would just be within that. It's being reported on the same tax return as if the plane was owned by operating company.
Okay, so if I'm understanding this correctly, the state bill is going to go to the purchasing entity, and then the IRS is going to expect the operating company to be responsible for like paying the bill, basically.
Yeah, well, the bill from the state, that sales and use
Right.
tax, that would come from purchasing entity.
Right.
If
And
the
then
IRS were to audit this operating company, it would all be on one tax return, operating company's tax
yes,
return.
that makes sense. Okay.
Yep.
Yeah. All right. No, that makes. Yeah, I'm with you. I'm with you now. Okay, cool. So let's talk about the difference between sales tax versus. I think that's kind of the natural next step as far as how aircraft taxes work. It's the buyer's responsibility. There may be a responsibility of the seller to inform or collect, depending on what's going on there. But it's the buyer's responsibility to pay that. But it's not just like, okay, I'm buying a car, I just have sales tax, or I'm buying a shirt, I just have sales tax. There's different kinds of taxes. So what is sales tax and how do we avoid it? But wait, if we avoid it, is there something else that the government will use to make sure that we pay our fair share, if you will? So yeah, tell us about sales tax first.
Yeah, we'll start with sales tax because that's probably the simplest. So sales tax is what can be incurred at the closing location. So where the plane is physically sitting when legal title passes to the buyer, that's where that sales tax liability can be created. So it's a very relevant part of the planning that we do. However, it's pretty simple to solve for, because if the plane's sitting somewhere that's unfriendly from a sales tax perspective, we can use Ohio for this example. They don't have what we call a flyaway exemption, which we can discuss in a minute.
Mm-hmm.
If we don't want to close while the plane's sitting in Ohio, we can move the plane somewhere where we are comfortable closing. So Indiana, for example.
Well, that was just it. Like, why not just close anywhere? And you're alluding to this idea that different states have different sales tax for when it closes. So there's some states that might be more favorable towards a closing within that state, is what you're saying.
Every state's statutes relating to this topic are different. So lots of states have a flyaway exemption, meaning you can close there, but the buyer's not based there. They're not going to use the plane there. They're just picking the plane up and leaving, and they're not a resident of that state. So they don't have to pay sales tax there. The state carves out an exemption for them from sales tax for that purpose. And then there's also states that don't have sales tax, period, or they specifically exempt aircraft from sales tax. So there's lots of friendly states. There are some unfriendly ones, but there's almost always some friendly ones nearby. So we can reposition the plane, close in that friendly state, and then thus we avoid the sales tax on the purchase of the plane. So it is important to handle it up front before closing, but it's generally a pretty easy part of the planning.
What would some of the tax-friendly states be, if you know any off the top of your head?
There's literally too many to list, but Kansas is a popular one. They have a pretty broad flyaway exemption. Tennessee as well. One that's kind of surprising, New York actually exempts aircraft currently from sales tax. So it can be a friendly place to close. There's lots of friendly places in the Northeast. Montana's one that everybody knows about because they don't have sales tax at all. So it's a friendly place to close.
But is my state Florida any good?
Florida does have a flyaway exemption. It requires a bit more paperwork than other states, though.
Oh, that's right. That's
so
right.
It's not the most unfriendly, but it's not the friendliest or easiest to comply with either.
So if that's the case, there's more tax-friendly states. Well, that's kind of an interesting ticker thing. My question was, what is a rough estimate of sales tax rate? Like, I mean, how much am I really saving? If I'm paying $10 million for a jet, I mean, if it's only going to cost me, 10 grand, to pay taxes, then maybe I'll just close there instead of having to relocate the aircraft and spend 10 grand in fuel. Like, it just doesn't make sense to move it.
Yeah, it varies from state to state what that rate may be, but on a $10 million aircraft, a typical sales tax rate's probably somewhere between 5% and, let's say, 9 or 10% on the high side.
Oh, wow.
So a much larger liability almost always makes sense to move the aircraft. Now, there are some states that cap sales tax. So like a South Carolina or a North Carolina, they both cap their sales tax on aircraft at very low numbers, 500 for South Carolina, for example. So in those cases, yeah, we wouldn't propose moving the plane if it's sitting in South Carolina. It's kind of on a case-by-case basis, but definitely a discussion that needs to be had.
So I'm going to pay taxes, or I'm not going to pay taxes. I'm going to close on my plane in Kansas or a tax-friendly state. And guess what? I don't need to pay the government anything for buying my private jet. I'm the man. I'm awesome. But wait, there's something I'm missing, isn't there?
There is. So wherever we're going to base, hangar, utilize the plane can potentially impose what we call use tax on the purchase price of the plane. And that use tax is generally the same rate as sales tax in that location. So we'll use Florida as an example again. Florida's sales tax rate statewide is 6% plus maybe some local, and the use tax rate is 6% plus maybe some local as well. So let's say a Florida resident just purchased a plane in Kansas. They're all excited. They met a sales tax liability or a sales tax exemption, from Kansas sales tax. So they didn't have to pay any sales tax at closing. They fly home to Florida, and then some period of time passes, and they get a letter from Florida that says they owe use tax, 6% use tax on their $10 million jet. So it's a $600,000 liability plus interest and penalties. And they say, wait a second, no, this can't be. I closed in Kansas. Unfortunately, they're mistaken. Florida absolutely can impose use tax because the plane is based and hangared there, and they're in some trouble there now. So the use tax planning is absolutely critical as well ahead of purchase. And most states have a variety of exemptions that can potentially apply. So it's really important to do proactive planning. You shouldn't, in most states, have to pay that $600,000 up front. There are some where you would. There are many others where you would not.
Well, after this recording, I'm going to have to call you. I got one of those letters that said, hey, Tom, you owe us money. So glad that you're bringing it up now. We'll definitely have to take a look at that. And so, okay, so now, if we have sales tax, we've got use tax, is it possible for someone to pay both, or do you only pay one or the other, or it depends on how you're playing the game? Like, what is that? How do they relate to each other, if at all?
Generally, it's one or the other. You'll be given credit if you pay one towards the other. So you generally are not double whammied, if you will. So you may end up paying the highest of the two tax rates combined. However, in practice, we almost never have a situation where we close somewhere sales tax unfriendly. So we're almost never going to pay that sales tax liability at closing, and it's almost always the use tax. However, we can have clients who are based in 2 states, and they may have to pay use tax in one
Oh,
state, and then it's a common question. Hey, I already paid. Let's just say they live in Ohio. I already paid Ohio use tax, and am I going to have to pay Florida too if I spend 6 months in Florida? You should be given a credit in most states. Depends on the statute, but that's generally what we see.
so just to be clear, what exactly is a flyaway state? I don't know if we actually defined it. We kind of alluded to what it is, but how would you define a flyaway state just so that, our viewers can get an understanding?
A flyaway state is a state that has a sales tax exemption that specifies if you close here, but you are not going to base the plane here, you're not a resident here. Basically, you're just picking up the plane and then leaving to go base the plane wherever you actually live. Then we're not going to charge you sales tax on the purchase price of the plane. The
Okay.
actual requirements in the statute vary from state to state, but that's the general principle of a flyaway state.
Gotcha. Okay. So I can't be a resident. What about a business? What if I have a business in Kansas? Does that count?
That varies from state to state. Some states,
Okay.
any amount of nexus can cause that exemption to not apply. Some states, it's easier. It's easier to have a little bit of nexus. Maybe you have a property there, or something along those lines. Maybe it's not problematic. So it depends on what's actually in the tax law itself, and that's something we have to evaluate prior to closing. But if you had, generally the principle is if you don't have ties there, plane's not going to be based there. It's just you're picking up the plane and leaving. No sales tax will be due if that's a flyaway state.
Gotcha. Awesome. Well, KJ, this is awesome stuff. We still have a lot to talk about. We still need to talk about tax planning and, of course, depreciation, the word of the hour. But before we get into that, I just want to give a quick shout out to our Circle community. So we'll be right back. Thank you so much for watching. If you haven't already, go to circle.jetlifearrow.com and check out our online community for aspiring brokers and current brokers. Here you'll find discussions, all things aviation's based, things that you're going to want to know as an aircraft broker. You can also check out our free training as well as more resources that are available to help you to become a better jet broker. That's circle.jetlifearrow.com to begin your journey within the broker community absolutely free. All right, and we're back with KJ McCarter from Aviation Tax Consultants. Thanks so much again for joining us. We just went through a great understanding of taxes in general, sales tax versus use tax, what you need to know if you're buying or selling your aircraft. Let's get into the big word of the year, or at least of the past couple of years, is depreciation. So the NBAA is a great site for depreciation, so you can kind of understand it. I mean, there's a whole Modified Accelerated Cost Recovery System, MACRIS, which I didn't even try to check that out. Depreciation schedules, bonus depreciation, lots of words, lots of buzzwords and things that have been going on, especially 2020. I think it was when it kind of kicked in, this idea of this bonus depreciation. So why don't you explain, KJ, over the past few years, what would happen tax-wise, or what was some of the reasons that people would buy a private jet for tax purposes as it applied to depreciation?
Yeah, absolutely. So the past few years, we've actually had 100% bonus depreciation until 2023 when it phased down to 80%. And now in 2024, it's phased down to 60%. But what that really means is bonus depreciation allows us to depreciate more of the plane in year one than the typical depreciation schedule. And that's very intriguing for buyers who have lots of taxable income because it allows them to reduce their tax bill substantially in the year they buy the plane and place it in service. So for example, in 2022, if you bought a plane, let's say you had $15 million of taxable income, you bought a $10 million plane, we had 100% bonus depreciation then, so you could write off the full $10 million. In 22, take your taxable income down to $5 million. So very, very large tax savings available in that scenario in 22.
Now, you were always able to depreciate the asset, correct? Just like you would like a business car or something like that. But but now we can do, or at least when it first started, it was 100% for a number of years, and then started dwindling down. 2023 was 80%. 2024 we're down to 60%, I believe, and it'll phase itself out potentially. We'll talk about it in a minute. But you could always depreciate it, even after this thing. If this bill dies, you'll still be able to depreciate your private jet, right?
Exactly. Yes. So the normal depreciation schedule for let's say a Part 91 plane is a 5-year maker schedule, or a 6-year straight line schedule. So it's still relatively short, and that's what we'll have if bonus depreciation truly does gradually phase down. We'll go back to being able to use 5-year makers and depreciate the aircraft over time. Bonus depreciation is not really, the bonus is kind of a misnomer. It's not, you're not getting anything additional, you're getting it faster, earlier.
And is that why sometimes people will call it accelerated depreciation? Is bonus and accelerated, are they referring to the same thing, or are they two different things?
Same thing. Bonus depreciation is a type of accelerated depreciation.
Gotcha. Okay. So when we're talking about this, what else can I write off from my private jet? Is it just the purchase price?
No. So the beauty of it is all of the aircraft related operating expenses essentially go into a bucket to potentially be deductible. So fuel, hangar fees, maintenance expense, every aircraft related expense goes into a bucket, which can potentially be deductible. And if you fly 100% for business, for example, all those expenses can be deductible and can reduce taxable income in the year they're incurred.
So you just brought up a really interesting point. You said if you're flying 100% for business. Let's take a big step back here. If I'm just going to use this aircraft for personal use, do I have depreciation? Do I have bonus depreciation? Does it matter if I'm using it personally or for business?
If it's all personal use, then the income tax discussion related to depreciation and writing off expenses is irrelevant. There will be no deductions to be had. So if you're a retiree, you sold your company, you're done working, then there's not much of a discussion to be had there. Still need to talk about the sales and use tax piece, because that's still relevant, and personal property tax as well. But the income tax piece, it's kind of like a personal car at that point. Where these items are relevant and matter is for a business owner buying a plane to fly around for their own business purposes. And they can have some personal use too. We can talk about that. It's okay to have a mixture of business and personal use as long as we account for it correctly.
Sure.
And it's essentially those expenses become prorated based on a calculation of how the aircraft is used.
Gotcha. Now that makes a lot of sense. So it's got to be for business use, which is interesting. And of course, as a aviation consultant, you can help demystify what business use means and how it can apply, or and be creative in that regard, based on the letter of the law, obviously. And so, okay, so we can depreciate it as long as we're using it for business use. I'm with you 100% there. So yeah, the costs, acquisition costs, the operating costs, the fixed costs, depending on what percentage you were doing for business. Okay, yeah, no, I'm with you. Is there anything in there that you want to highlight for our viewers?
Yeah, I can quickly touch on the kind of business versus personal use breakdown and really what that impacts. So as you mentioned in the note below, the expenses are basically prorated based on how much of the use of the plane is for business purposes and how much is for really entertainment purposes, which cannot be deductible under the current tax code. So the IRS requires us in most scenarios to do basically a weighted seat hour calculation. And they want to know who's on board and why. So for example, let's say there was the owner of the plane was flying somewhere for a business meeting and was bringing along 3 of their family members who were coming along, and they were just going to go to the beach during that business meeting. So we have 1 business passenger, 3 what we would call personal entertainment passengers on that flight. We have to do a weighted seat hour calculation to essentially not deduct 75% of that use.
Oh,
so
wow.
We do that on the whole year basis using the finalized flight log, and that percentage is what we use to apply to those expenses to figure out what's deductible and what's not deductible. And similar rules apply with the depreciation, although it can be a slightly different calculation.
Gotcha. That's really granular. I get it.
Yeah.
I get it.
Yep.
It's called job security for you.
Exactly. And that's what I was about to bring up. The rules are kind of confusing here. So if a buyer goes out and tries to figure this out on their own, or they rely on their CPA who may have never accounted for a plane before, they may get it wrong, or they may not even realize they have these requirements. So that's a big part of our value. We know exactly what the rules are and how to apply them to the buyer situation.
That makes sense. So what about closing as far as dates go? I know I kind of jumped around a second, but I was curious about if you're coming to the end of the year, can I buy a jet? Do I have to fly it in the year for it to count for this year's depreciation? Can I buy it and then not fly it? Do I have to fly it? Like, what does the government count as, okay, now is when you own it, you've used it for business, and you've qualified for bonus depreciation? I remember that being kind of a topic for people, because they would buy it, but they didn't fly it, and they were rushing to get a flight in real quick, on New Year's Eve for business purposes, so that it would qualify. Can you speak a little bit to that?
Yeah, excellent question. A plane does have to be placed in service in a given tax year for it to be depreciated in that tax year. So what that means is, let's say you closed on a plane on December 31st, and then it didn't fly. The plane was not ready and available for its intended use. You closed, and then the year ended, and that was it. The IRS would have a pretty strong argument to say, hey, that plane is not placed in service in that tax year, and it can't be depreciated until next year. So
is placed in service just taking a flight?
That's the best way to place a plane in service, is use it actually for a legitimate business mission of some sort, to show that the plane was in fact ready and available for its intended use, which is the definition of place in service, because it was used for that. It can get a little bit more gray. Let's say in another scenario, you close on the plane on December 31st, and then it repositions back to base, but that's the only flight. Taxpayer may have an argument that the plane was ready and available for its intended use because it was capable of flying, but the IRS may try to challenge that. So when possible, we always like to see a business flight before year end. That's what we advise our clients to do. Some situations don't allow for that, but there's some gray in between there for sure.
Always love operating in the gray, for sure. Great. Well, hey, we're kind of starting to wrap up. We're just going to kind of close on some tax planning items. What are some tips or some piece of advice that you would have when it comes to, closing to minimize tax exposure, tax planning? Like, I guess kind of overall, obviously the big themes are, depreciation and writing off, how much you're using it, and making sure you're paying your sales taxes. Is there anything else in the overall scope of services that you guys provide that you would want the viewers to be aware of?
Yeah, I would say my number one tip by far is just give us a call whenever you're contemplating an acquisition, even if it's not within that 1 month time frame before closing, even if you're just starting to consider the acquisition, and we can talk about all of these topics and zoom in on your exact facts. So everything we talked about today is at an extremely high level. We can go granular with you, specifically the buyer's facts, and advise you of what kind of sales tax planning, use tax planning, personal property tax, income tax planning we can help with, so that you have an idea. And it's so important to proactively handle these items rather than waiting until you own the plane and then starting to think about these things. So that's the one actionable item. Email me, give me a call. We can talk about these things specifically as they relate to your facts and how we may be able to help.
All right, KJ. So you mentioned, sales tax and use tax. It sounds like if I owe the government $1 million in taxes, whether I pay it at the time of the sale or I pay it because of use tax, even if I do a flyaway state, I'm still kind of paying $1 million. Are there any ways? Obviously, we can get creative with the sales tax by going to a flyaway state, but what about with use tax? Are you aware of certain avenues that can help someone mitigate the use tax as well?
Yeah, absolutely. Great question. And the answer is yes. It varies widely from state to state, but generally there are options to either eliminate, be exempt completely from that use tax liability in the state where the plane is based, or maybe minimize it or spread it out. So we used California as an example in a $10 million plane, potentially having $1 million use tax liability in California if the buyer's caught off guard. But for example, if they work with us or another aviation tax professional, there's a very friendly exemption in California actually that could allow them to be completely exempt from California use tax based on out-of-state business use. So almost all of our clients are completely exempt from California use tax. They save that million and proactively submit that exemption to CDTFA. And there's lots of states that have these very surprisingly friendly exemptions from aircraft use tax. For example, Texas too. Their use tax is pretty high, can be as high as 8.25%, but they offer an exemption based on out-of-state departures in the year following purchase. So again, almost all of our clients are exempt from that Texas use tax on the purchase price of the plane. And Florida and Indiana and a whole host of other states also offer friendly exemptions. The important piece is to evaluate those options prior to closing because a lot of these have actionable items that need to be done before closing occurs. So in addition to finding a sales tax friendly state, we need to be thinking about meeting a use tax exemption of some sort in the state where the plane's going to be based.
That makes a lot of sense. And again, like I said, for you, it's job security. It's knowing, which states and the statutes and the laws and everything that allows your clients to take the most advantage. It's a game in some ways, and the more you know the rules, the more you know the strategies. It's to your benefit, and that's exactly what you guys do at Aviation Tax Consultants. So. All right. So when it comes to buying your first jet, some people don't necessarily look into the company structure of how they want to make this purchase, where the aircraft is going to be located. Do I buy it as an individual? Do I just make my tech company buy it, or do I set up a third entity to do? So I drew a drawing, and be gentle, KJ. It's not my best drawing or anything, but I think it makes sense. If you could just kind of take a look at it for me and tell me, does this make sense, and how would you explain this to me like I'm a 5-year-old, for a Michael Scott reference? But yeah, go ahead, dude.
Absolutely. Yes, this is a very common ownership structure that we see for a variety of reasons. But in this diagram, you have the tail number of the plane, and you can see that plane is owned by what we would call a plane co. So that's the special purpose entity that holds title to the plane. To use previous examples, if there were a state reaching out to impose sales or use tax on the plane, they'd be reaching out to Planeco because Planeco holds title to the plane. It owns the plane. And then in this diagram, OpCo owns Planeco. So OpCo, if you want to think about the different types of buyers that there may be, maybe it's a construction company that's purchasing a plane, or a consulting company, or a manufacturing company of some sort. That operating company is that business that has lots of taxable incomes and activities and has a need for the plane, but it owns its plane through Planeco. So as a wholly owned subsidiary that's called Planeco, it'd have a different name than that, but that subsidiary is what would actually hold title to the plane. So from an income tax reporting perspective, an IRS perspective, these are generally viewed as all one entity. So Planeco is reported and disregarded to the OpCo tax return. The aircraft is reported directly on that construction company, consulting company, manufacturing company tax return altogether. And there's a variety of reasons why that is often very beneficial for the buyer.
Gotcha. No, that makes a lot of sense. I'm glad my drawing makes sense. Hopefully it makes sense to the viewers. And thank you so much for explaining it so well.
Yeah, absolutely.
All right, so we took care of sales tax, we took care of use tax, we talked about depreciation, we talked about everything. Have we talked about anything? I mean, is there any other? I mean, it's the government, right? I mean, they're looking for their money. Is there anybody else or any other fees that might be attacking us, maybe on an annual basis or a one-time basis? Even if there's nothing that we can do about it, if I'm buying a jet, what else should I be aware of?
Yeah, so it varies from state to state. Sales and use tax is pretty common across the board. Sometimes there's excise taxes or registration taxes or fees, but the other big bucket that we haven't talked about yet is personal property tax. that can be due on aircraft. Not every state imposes personal property tax on aircraft, but many do. And that liability is a little bit different because it's an annual liability, unfortunately, and it's actually due to the county in which the aircraft is based. In most states, there's not a whole lot to be done about that one, other than just being aware that that liability exists, and you may have to pay that every year to the county where the aircraft's based. There are a few states that offer proration or reduction opportunities based on out-of-state use of the plane. Call or email us to discuss and see what those options may be, but it's very important to understand that depending on where you base the aircraft, you may have that liability annually.
Wow. Okay. Well, there's a lot to this whole tax thing, and I imagine it's probably best for someone to come to you with their exact situation so that you can advise them. It's one of those unique industries where, some industries just like, okay, here's the general information and it'll apply to most situations. But when it comes to taxes, I mean, people's business structure and their tax structure is so unique. I guess we call that job security for you guys. So they should definitely get in touch with you.
Yeah, you hit the nail on the head. The answers to these types of tax questions vary widely depending on the facts related to the type of business that's buying the plane, where the plane's going to be based is absolutely huge. How we're going to utilize the plane, the nature of the business, all those items can vary the answers here. So the easiest way to get good answers is to call or email us and discuss your specific set of facts. We can give you precise answers quickly. And as you alluded to, it's hard to give high-level answers to these questions because the answer is almost always it depends. So the easiest thing to do is call us and discuss.
That's awesome. So as I'm scrolling through your website, I see you've got a frequently asked questions on here as well. So if you have some more questions, they may have already been answered on the Aviation Tax Consultants website. So definitely check that out. And KJ, thank you so much for being here and talking to us about these taxes. And I just want to throw this up here: Aviation Tax Consultants. .com. Where else can people reach you, connect with you? Again, thank you so much for being here.
Yeah, absolutely. Thank you again for having me. We're on LinkedIn. We have a Twitter as well. All the social medias, you should be able to find us there. And we're on the road constantly at different aviation events. So stop by our booth. We're around. And like I said, call us, email us anytime.
Awesome. All right. Well, thank you so much. And we really appreciate being here. We'll catch you later.
Thanks.